Welcome to the Debit and Credit online classroom. Today's class we are going to discuss about some important terms like bookkeeping, accounting and accountancy, then branches of accounting, stakeholders of accounting information, advantages of accounting and limitations of accounting. Bookkeeping. What is this bookkeeping? Bookkeeping is an art of recording in books of accounts the monetary aspects of commercial or financial transactions. So bookkeeping is an art of recording. In accounting, we are recording all the transactions which are in terms of money or measurable in terms of money. So bookkeeping is recording of these transactions in the books of accounts, the monetary aspects of commercial or financial transactions. So whatever transactions which are in terms of money or which are measurable in monetary aspects, we will record in books of accounts. That is called the bookkeeping. Accounting means collecting, summarizing, analyzing, and reporting in monetary terms information about business. The transactions which are in terms of money or which can be measured in money are recorded in books of accounts. That we will call bookkeeping. And accounting means it's a collecting of or collection of all these transactions. From where we'll get the data to be collected. Suppose if we are buying a notebook from a shop, when we give the money, they will give you a bill. That itself is the basic document of a transaction. So these bills, receipts or cash memos all are the basic documents from where we can collect the data about the money transactions. So by collecting like that, we will record that in the books of accounts and will summarize it. How similar transactions are grouped into one, and then we'll analyze and report to the management. So that is the accounting procedure. Accounting means collecting, summarizing, analyzing and reporting in monetary terms information about business transaction. Accountancy refers to a systematic knowledge of accounting concerned with the principles and techniques which are applied in accounting. So when we account, there should be some principles or some rules to be followed. And using these principles and techniques, we'll record the transactions in books of accounts. So this is a systematic knowledge of accounting concerned with the principles and techniques which are applied in accountancy. That is accountancy. So that systematic knowledge of accounting is the accountancy. Accountancy refers to the entire body of the theory and practice of accounting. So the rules or the principles or the techniques to be followed, that systematic knowledge is the accountancy. Now let us see the difference between bookkeeping and accounting. We'll think that bookkeeping and accounting are the same because we are recording the transactions in both. But there is difference between this bookkeeping and accountancy. Let us see. About the scope, bookkeeping includes identifying the transactions of financial nature. That is, when a transaction has occurred, then we should know whether it's a monetary transaction or whether we can measure it in terms of money. Measuring the identified transactions in terms of money, recording the measured transactions. If it is a monetary transaction or a transaction which can be measured in terms of money, then we can record and classifying them into ledger. Yes, grouping and classifying that posting in ledger. Till then, it is the bookkeeping procedure. So first of all, we have to identify the transaction, whether it is a monetary transaction or whether we can measure in terms of money. And if possible, then we will record it, that is journalizing. We'll write the books of accounts. Then the similar transactions are grouped, that is the classifying, and it will be recorded in ledger books. So this is the bookkeeping. And accounting in addition to bookkeeping includes, because all these activities are there in accounting. So bookkeeping is the beginning of accounting. Then accounting in addition to bookkeeping includes summarizing the classified transactions, analyzing and interpreting the summarized results, and communicating the result to parties interested in them. So after posting in the ledger, we will summarize it. That is, for a particular accounting period, what has happened, what is the result. That is what we need to know. After many transactions, what has happened, whether the business has made a profit or a loss. That is what we want to know. So for that, we have to summarize these and analyze and interpret. We have to analyze the things and then interpret the summarized results, and it should be communicated to the users of this accounting, that is the owners, the managers, then employees, financial institutions like that. Then at what time we are doing the bookkeeping and accounting procedure. Bookkeeping is the primary stage. In bookkeeping, we know that we are identifying the transactions, and if it is in terms of money, then we will record it, and then we will group it and write in ledger books. So that is the primary stage. And accounting is the secondary stage. Accounting starts where bookkeeping ends. In accounting, in addition to the bookkeeping, we have to summarize, analyze, and interpret and communicate. And about the objectives, the main objective of bookkeeping is to maintain systematic records of transactions of financial nature. We have to use the systematic knowledge of rules and the principles and techniques to be followed. That is the accountancy. So we have to maintain the systematic records using this systematic knowledge. In accounting, main objective was to ascertain the net results and financial position of the business and to communicate them to the interested parties. Bookkeeping, we are just simply recording it, but in accounting, we are summarizing, analyzing, and interpreting and communicating. About the nature of job, bookkeeping is a routine and clerical job. Accounting function is analytical in nature. That is, we have to analyze the report. Bookkeeping function is performed by junior staff. Accounting function is performed by senior staff. Why? We should have the knowledge to summarize it, analyze and interpret it, and communicate it. It can be performed, bookkeeping can be performed by persons having limited level of knowledge. It is just a clerical job, just recording it, just analyze the transaction and see whether it is a monetary transaction or measurable in terms of money, then record it. That junior staff can do. But this interpretation, analyzing, and communication, all these needs more knowledge, higher level of knowledge. Bookkeeper is not required to possess any analytical skill, but accountant is required to possess analytical skill because it is his duty to analyze the summarized data and interpret and communicate. Now let us see the distinction between accounting and accountancy. Accounting is concerned with recording, classifying, and summarizing of transactions. Accountancy is a body of knowledge prescribing certain rules or principles to be observed while recording, classifying, and summarizing of transactions. Accountancy gives the rules and principles to be observed while doing the accounting function. Scope of accounting is very narrow. Accounting starts where bookkeeping ends. But accountancy is having a wider scope and includes bookkeeping as well as accounting. Accountancy starts from identifying the transaction and ends with communicating the result to the stakeholders. Accounting depends on bookkeeping. Accountancy depends both on bookkeeping and accounting. Main function of accounting is to ascertain the net results and financial position of the business and to communicate them to the interested parties. Accountancy includes the decision-making function also on the basis of information provided by the bookkeeping and accounting. The branches of accounting are financial accounting, tax accounting, social responsibility accounting, cost accounting, and management accounting. Now let us see what are these accounting procedures. First one is financial accounting. Financial accounting records the business transactions in a systematic manner to ascertain the profit or loss of the accounting period by preparing profit and loss account and the financial position of the business by preparing balance sheet. So it records the business transactions using the principles and techniques and ascertain the net result of the business and shows whether it's a profit or loss and shows the financial position of the business by preparing a balance sheet. That is the financial accounting. Cost accounting is to ascertain the total cost and per unit cost of goods produced and services rendered by a business. It also estimates the cost in advance and helps the management in exercising strict control over cost. Whereas management accounting presents the accounting information in such a way as to assist the management in planning and controlling the operations of a business. The management accountant uses various techniques and concepts to make the accounting data more useful for managerial decision making. The techniques include ratio analysis, budgetary control, fund flow statement, cash flow statement, etc. Tax accounting is used for tax purpose. Income tax and sales tax are computed on the basis of this accounting. Social responsibility accounting is the process of identifying, measuring, and communicating the contribution of a business to the society. The contribution of a business to the society consists of providing employment to underprivileged, providing financial and manpower support for public programs, environmental contribution, product safety, product durability, customer satisfaction, etc. In social responsibility accounting, techniques have been developed for measuring the cost of these contributions and benefit to the society. Now let us see who are the users of this accounting information. Accounting information is used by various groups of people who have contact with the business enterprises. They use accounting information in order to satisfy some of their varied needs for information. These users can be divided into two. They are the internal users and external users. Let us see who are these external users. Individuals or organizations who have present or future interest in the business enterprise but are not part of management are called the external users of accounting information. They are the lenders, the people who give loans to the business, investors who invest in the business for getting interest, then governments, consumer groups, external auditors, then customers. The lenders or the creditors, they want to know the creditworthiness of the business enterprise. They want to know whether the amount owing to them will be repaid when due and whether they should extend, maintain, or restrict the credit to the enterprises. Investors want to know how safe and rewarding the proposed investment will be. Tax authorities or the government, they want to know information for the assessment of income tax, excise duty, value added tax, etc. Government and their agencies need information to form policies relating to taxation, allocation of resources, and for providing subsidies, etc. The public want to know how they are going to be affected. And customers, they want to know whether they will get the products, good quality products, and whether they will get it for a long run. Now the internal users. Internal users are the persons involved in this business, either as the management, the owners, or the managers, officers, internal auditors, sales staff, employees, etc. The owners contribute capital in the business and as such want to know about the profitability and financial soundness of the business. They want to know how the business is going, whether they are going to get good profits and whether they can increase the profit in future, or whether the business is coming down and whether they have to shut down the business. So valuable informations are expected. The management need accounting information for the efficient and smooth running of the business enterprise. They need the correct information so that the decisions can be made with this information. Employees need information about the profit of a business to assess the ability of the business to pay higher wages and bonuses. They may also use the financial statements to ascertain whether various amounts due to them, such as provident fund, are being deposited regularly, whether they will get bonus, etc. Let us see the advantages or the uses of accounting. It is helpful in management of business for planning for the future, for the decision making and controlling. Management would like to know whether the sales are increasing or decreasing and also the speed of increase in cost of production With such information, they have to plan for the future. The management has to take a number of decisions. For example, what should the selling price be? How much discount should be offered to the customers? Accounting provides all the information required for such decisions. Management wants to do the control also. Management would like to see that the cost incurred is reasonable and that no department is overspending. Then provides complete and systematic record. The business transactions have grown in size and complexity, and it's not possible to remember each and every transaction. Accounting keeps a prompt and systematic record of all transactions and summarizes them in order to provide a true picture of the activities of the business entity. Information regarding profit and loss. By preparing the financial statements, that is the profit and loss account, will know whether a profit or a loss has come after the transactions for an accounting period. Information regarding profit is of great use to the owners and various other interested parties. Information regarding financial position by preparing the balance sheet at the end of each accounting period is also very important. A comparative study can be done using these statement of profit and loss and balance sheet. This helps in assessment of tax liability like income tax or sales tax. It's a evidence in legal matters also. Properly maintained accounts supported by authenticated documents are accepted by the courts as a firm evidence. Helpful in raising loans. The loans will be sanctioned by the financial statement of institutions only after checking the accounts statements, like the final accounts, that is the profit and loss account and the balance sheet, fund flow statement, cash flow statement, etc. Helpful in prevention and detection of errors and frauds. If the transactions are recorded properly using the principles and techniques specified with a supporting document, it will prevent the errors and frauds. We have discussed the advantages of accounting, but there are some limitations for this also. First one is the omission of qualitative information. For accounting purpose, we will take only the transactions which are measurable in terms of money or the monetary transactions. Suppose we have a very good employee in the business, but we cannot account or record that. So that is the omission of qualitative information. Then this accounting is based on accounting concepts and conventions. The basic accounting concepts and conventions we will learn in next class. So using the conventions and the concepts, which are not that much realistic, we are preparing the accounting. So some reliability is lost. Then sometimes it will give incomplete information also. Accounting statements provide only incomplete information because the actual profit or loss of a business can be known only when the business is closed down. As a going concern, it will give only the partial information. And this is based on historical cost. Only after the happening of a transaction it is recorded. So we can't control that particular expense. So that limitation is there for this. And it is affected by window dressing. What is this window dressing? Window dressing refers to the practice of manipulating accounts so that the financial statements may disclose a more favorable position than the actual position. So, window dressing is the practice of manipulating accounts so that the financial statements may disclose a more favorable position than the actual position. For example, the purchases made at the end of the year may not be recorded or the closing stock may be overvalued. Hence, the correct decisions cannot be taken on the basis of such financial statements. Sometimes overvalue will be done for the assets. Sometimes the liability will not be disclosed properly. So all this will affect the accounts. That is and they will manipulate the account to show higher profit. That is the window dressing. And sometimes this accounting procedures influenced by personal judgments also. And sometimes it will give a incomplete information. With this, we can wind up today's class, and in next class we'll be discussing about the important accounting terms. I believe that you have understood the theory of accounting, the difference between bookkeeping, accounting and accountancy, the advantages and limitations of accounting, who are the stakeholders of accounting, etc. Thank you very much. If you have not subscribed my channel, please subscribe it. Don't forget the three words: like, share and comment. Please put your comments in comment box. Thank you very much.